Hi, I'm Tom Lydon, editor of ETF Trends, here in Boston at the Charles Schwab Impact Conference. I'm here with Simeon Hyman, head of investment strategy at Proshares. Simeon, great seeing you.
How are you, Tom? Thank you.
Great. What do you think of this conference?
Massive, impressive, and high energy.
But isn't it great how ETFs have a bigger and bigger footprint here at Schwab?
You know what? It keeps growing every year. The liquidity, the transparency, and the efficiency of the market has really spoken volumes to investors.
Absolutely. Now, a lot of people have been focused on dividend, but mostly large cap dividend. You folks have found ways to grab dividends from other asset classes.
We have indeed. We have a whole suite of dividend growth. The important thing about dividend growth is that it's a focus on quality companies, not just the highest yielding stocks in the universe, and those things have interest rate risk and a lot of utilities and things like that.
Right.
But there's an opportunity to go beyond dividend growth just in large caps, and we've had great success there. You're familiar with our ticker NOBL, which has raised almost $1 billion.
Noble.
But we're encouraging people to go beyond Noble and to look at the opportunities in mid-cap, small cap, and international, where our full suite of dividend growth has proven to be quite effective, and particularly in turbulent markets. They did very, very well in August and September, setting themselves up for a strong year of outperformance. So that's an important thing we'd like people to look at. Take dividend growth beyond just U.S. large cap stocks.
A lot of people don't realize that there are a lot of small companies and mid-sized companies that have cash and prefer to give it to their shareholders, and you've done a great job of creating indexes that focus on that.
You're absolutely right, Tom. SMDV is the small cap flavor, and when we look at that performance, what we see is the opportunity to get the growth aspects of almost a small cap growth index, but with balance sheets that have the quality of a value balance sheet. It's almost a GARP kind of growth at a reasonable price, but even better than that, it's growth with quality. That is a interesting manifestation of the dividend growth strategy in small cap.
Yeah, absolutely. And also, we've talked about this before, there's certain regions in the world who have an investment culture that dividends are very important to them, no matter what size the company is. Is
they
that
do,
right? Yeah.
And as a matter of fact, for people who do want a little extra yield, chasing it in the U.S. in high-yielding stocks can be a strategy that might bring a lot of that interest rate risk back into your equity portfolio.
Right.
But moving the dividend growth strategy internationally can pick up those yields. So as an example, ticker EFAD, which is our dividend growth strategy culled from the MSCI EFI index, has a 3 handle on its yield, just a little over 3%, but doesn't have all that interest rate risk that comes with loading up on utilities and things like
absolutely. Okay, so you mentioned interest rate risk. What's the number one thing Proshares is talking to advisors today about as we approach the end of the year?
Well, people are very focused on the Fed, and it does look like there might be a move in December. But my counsel is, look, even if the Fed does nothing, you should be worried about interest rate risk in your portfolio. To me, the risk is asymmetric. When the S&P dropped 11% in August, the 10-year bond rallied all of 12 basis points. So if you had a bond with a 10-year duration, you made 1% as the S&P cratered. Is that really enough benefit in your portfolio to take the risk of losses when those interest rates tick up? Just in the last month, they went up about 30-odd basis points. You'd have lost 3% in that 10-year duration product.
So briefly, as we're wrapping up here, some of the strategies that you have within these products, especially where you're short treasuries but actually long corporate bonds and high yields, might be perfectly timed for this rate hike that we're seeing.
Indeed, we have 2 interest rate hedge bond products, ticker HYHG, which is the high yield flavor, and IGHG on the investment grade side. They're long corporate credit, as you indicated, but short treasuries to get down to 0 duration. When the economy improves a little bit and those rates tick up, as we've seen strong employment numbers, better consumer confidence, typically those spreads will come in. So having that corporate credit exposure, but taking out the interest rate exposure is a great opportunity in the current environment.
Excellent. Simeon, as always, you guys have great tools, great ideas. Thanks so much.
Thanks for your time.